In this world, nothing can be said to be certain but death and taxes. You see, I don't know about that, Ben, because I'm pretty certain getting kicked in the nads hurts. Anyway, tax on your investments. When do you pay it, when do you not? How much do you have to pay, and who do you even pay it to? And more importantly, is there a legal way for you to avoid all of this tax and still not get into trouble? All of that will be covered in today's video. Before we start, I just want to say, I'm no tax expert. All of the information I'm discussing here is available on the .gov website that I've linked in the description below. Go check it out. But because this video is talking about getting taxed, I think it's appropriate today that we start with, let's not get it. Imagine an organisation that can enter your home against your will and take anything they want. An organisation so powerful that they can alter your tax code, deduct money from your wages, or even just straight up empty your bank account while you sleep. They have more power than the police and more cash resources than the NHS. This organisation is so important that the Queen herself announced the formation of it during her speech in 2004. In fact, she likes it so much, they named it after her. HMRC, Her Majesty's Revenue and Customs.
I'm so proud of it, I put my name on it.
One of the best things about video editing is I can make jokes about the Queen and George Foreman all in the same sentence and people still call it informative. But tax is no joke. Not paying your tax intentionally carries a heavier prison sentence than some pretty heinous and grotesque crimes. And while none of us like paying tax, we pretty much all agree that it's a necessary evil and it's just something that it's best to make sure you're on top of and that you always pay what you owe. So as an investor, when you first enter the ring and you start making a bit of money, the first thought can be, how much tax do I owe on this? We hear that an ISA stops tax, but then when we buy shares, stamp duty is applied. Isn't that for houses? Let's break this down, looking at the taxes you pay when buying, owning and selling your stocks and shares. And then we'll look at ways that you can dodge them legally, so Liz don't come knocking for her lunch money. So we'll go over the taxes you pay and when, what the percentages are, and a few ways that you can compliantly avoid them. For those of you who regularly watch my channel, none of the information here is going to be too groundbreaking, but I think it's important that we cover it and that we have it all in one compact place, because I get a lot of questions around tax. So let's start with taxes when you buy. If you've purchased shares in a business, whether that's inside an ISA or not, you'll probably have noticed a 0.5% deduction for stamp duty. This is not to be confused with the stamp duty that's applied when you buy a home, which is called stamp duty land tax. This is instead called stamp duty reserve tax. This is a tax applied to all UK shares and can't be avoided through the use of an ISA. So even though an ISA will prevent you from paying capital gains tax and dividend tax, which we'll cover in a minute, you can't sidestep stamp duty by using an ISA. Stamp duty is a UK phenomenon. Phenomenon? Stamp duty is a UK phenomenon, so you won't pay it on shares listed on foreign exchanges like America, but then you'll probably be paying a currency exchange rate fee anyway, because you're buying shares in a different currency, so when they flip your pounds to dollars, they charge you a fee for this. Just like if you go to a post office and buy currency over the counter, they charge you a fee. So buying international shares only will avoid stamp duty, but then you're just going to incur costs for currency conversion. Interestingly, ETFs, or exchange traded funds, you don't pay stamp duty on, but on an index fund you do. Now before you start kicking yourself that you bought a load of index funds and that you should have gone down the road of ETFs, a lot of ETFs have a built-in cost that really levels the playing field with the stamp duty. So honestly, buying ETFs, you might be slightly better off if not at all. Moral of the story, stamp duty can't really be dodged. You pay it on shares and funds listed in the UK stock market, ETFs don't pay it, and may be slightly cheaper as an investment for that reason. But yeah, stamp duty, get used to it, it is what it is. Now let's move on to the taxes you pay when you own and sell your shares. Just before we do this, I want to stress the importance of using an ISA for long-term investing. I then also want to completely contradict myself by saying that you don't always need to invest inside of an ISA to avoid capital gains and dividend tax. Slightly confusing, let me explain what I mean. The reason an ISA is a great tool for long-term investors is we hope that at the end of the journey, when we come to use the money, there will be a lot of it. Tens, if not hundreds of thousands, maybe even a million. At those levels, dividend and capital gain taxes become pretty grim. But it's also worth noting that each year, everyone in the UK gets a tax-free allowance for both capital gains and dividend tax. It's like a government-backed free sample on those types of income. So as long as you don't earn more of that income than the tax-free allowance, then that free sample, You don't have to pay tax on it. One such tax-free allowance or free sample that you might be familiar with is the one that applies to your income tax. So most people watching this video will get £12,500 worth of tax-free income each year. So if you earn 25k a year from your job, the first 12.5k that you earn isn't taxed. That's your income tax tax-free allowance. That's your income tax free sample. So dividend tax and capital gains tax both have free samples as well. They're just different amounts. Lovely stuff. So first up, dividends. Dividends are the income you receive from a business for owning shares in it. If stocks and shares were houses, then capital gains would be the house price increasing in value, and dividends would be the rent you receive each month from the tenant. Dividends are taxed depending on how much you earn, but not just of dividends, in total, your total income. So it's just like income tax really, where if you earn more money, you're taxed more. So a lower rate taxpayer will only pay 20% in tax, whereas some of the higher earners in the UK will pay up to 50% of their income in income tax. Dividends are exactly the same, it's just the banding amounts are different. But it's all calculated based on your total income, not just on your dividend income. So when they work out how much tax you need to pay on dividends, they look at how much you earn in total. Here are the rates you pay at different income levels. The more you earn, the more you pay basically. So what are the ways that we can legally avoid paying this dividend tax? Well, the first of them is an ISA. Honestly, ISAs are wonderful things. In the UK, we have one of the best tax-wrapped advantage account systems in the whole of the world. On the other side of the Atlantic, our gun-toting counterparts, the Americans, have a system called the IRA system. Slightly worried that I just said gun and IRA in the same sentence. Not sure the YouTube algorithm's going to like that. But yeah, the Americans have IRAs, and as far as I'm aware, they can only put £6,000 a year into an IRA, whereas we can put 20k a year into an ISA and have it sheltered from tax. So you put your 20k a year up to 20k a year into an ISA, that grows, and no matter how many dividends you get on a daily, weekly or monthly basis, you will not be taxed on any of them ever. Amazing. But it's also worth noting that everyone in the UK gets £2,000 a year in tax-free dividends. That is your dividend-free sample. So you can earn that amount in dividends before you need to worry that these tax rates start applying. The reason this is important is to receive £2,000 a year in dividends, you would actually need about £50,000 invested into stocks and shares. It's quite a lot of money. Now, while over 10, 20, 30 years of investing, it's more than perfectly reasonable to expect that you would get to that level. If you're currently investing into an ISA with the likes of Vanguard, but you want to have a play around on other platforms like Trading 212, unless you're making massive swings straight out the gate, the concern about hitting £2,000 a year's worth of dividends really it shouldn't be there. ISAs are amazing at protecting our long-term huge pots of cash, but the 2k allowance on dividends gives you cover day to day to duck about and dabble on other platforms without really worrying about the tax. But if you're not in an ISA and you get more than 2k in dividends, you will start to pay tax based on these figures. Make sense? No? Okay, good. Next up, capital gains. And it's a similar story. Remember the house example, where dividends is the rent and capital gains is the increase in value. So if a share increases in value, your money, your capital has gained or increased. So you pay tax on that increase. That is capital gains. Now, ISAs, those sexy little things, protect you from capital gains tax. So any money that you invest inside of an ISA, no matter how big it grows, you will not pay capital gains tax on it. But just like dividends, you get a tax-free allowance or you get a free sample with your capital gains. And that is £12,300 per year worth of capital gains before you start paying tax on it. But this free sample applies to all assets. Houses, art, wine. That £12,300 isn't just for shares. It's for anything you make money on, anything you gain capital on. You then pay capital gains tax at these rates. The reassuring thing is that £12,300 to most of us actually represents a significant gain. As long as you've got your ISA in the background protecting your retirement pot from taxes, you can feel confident enough that you can go around and invest on different platforms if you like. As long as your total gain doesn't exceed more than £12,600 in a year, you won't pay capital gains tax. Just because your shares in Tesla have gone up 20 quid doesn't mean Liz is going to kick your door in. I nearly said back door then. I realised that the idea of the Queen kicking in people's back doors might not go down too well. With Liz smashing back doors in and comments about the IRA and guns, I don't think this video is going to do too well with the algorithm. If you're a baller and you earn over 2k in dividends or £12,300 in gains on shares that are not inside of an ISA, you will need to complete a self-assessment tax return, telling Liz how much you earn and she will send you a bill. You can download this form here, you can fill it out yourself, it's pretty easy, or you can pay an accountant to do it with all those sexy gains you got. I always try and remind myself that paying more tax really is a privilege. If I'm paying more tax, it's because I'm earning more money, and that's always a good thing. Use ISAs for your main investing, and feel free to play around on other platforms as long as you don't exceed the allowances we discussed. The system is set up to help you grow your wealth and avoid it being taxed. Use it to your advantage. It's not illegal, it's not tax dodging. All you need to remember is...
if you can dodge a wrench, you can dodge a ball.
What?
I'm sorry guys, I have no idea what relevance that has to what I just said. Should probably just end the video there. R.I.P. Patches O'Houlihan.